But what I won't take credit for is I didn't say, okay, I'm going to get out of the corporate world one day from this. I was always in the corporate world thinking that I wasn't maximizing my potential, and it was killing me because I'm sitting behind a desk at a middle-level management job, supervising multiple people, Toyota headquarters, Disney headquarters, and it's a great job, and no one should complain. But I knew in my heart that I was not maximizing my potential. And to Christina's point before, my passion was always investing. I was always doing a lot of it on the side. I was always watching CNBC every day at work. Mm-hmm. And I just didn't realize that could be my full-time thing. And what happened for me is that once I rotated my money from stocks and bonds into cash flow, I was going to just have the paycheck and the cash flow and just keep going that route. But I had a last straw moment in the corporate world in 2007 with a new manager that when I changed divisions within Toyota. And that was the worst thing that happened to me at the time, but the best thing that happened to me in retrospect, right? And that's actually what gave me the courage to actually say, I've got the cash flow I can live off of if I want to. Let me give this a try for a year or two. So, I'm a very low risk guy. So I had the cash flow coverage. I said, let me try it for a year or two, see what happens. And it's kind of been able to just continue on. And, my main objective is to just continue to grow my cash flow snowball so I never have to go back to the corporate world. That's been from the start, from the day that I left the corporate world. And it continues today.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. Today, I have with me Jeremy Roll, and I am particularly excited. He's part of the Roll Investment Group. Actually, he is the Roll Investment Group, but he's also an independent investor. So let's read his background. Jeremy started investing in real estate and business in 2002 and left the corporate world in 2007 to become a full-time passive cash flow investor. He's currently an investor in more than 60 opportunities across more than $1 billion worth of real estate and business assets. As founder and president of Roll Investment Group, Jeremy manages a group of over 1,500 investors who seek passive, managed, cash flowing investments in real estate and business. Jeremy is also the co-founder of For Investing by Investors, which is the group that I have as well. I am part of his network, a nonprofit organization that was launched in 2007 with the goal of facilitating networking and learning among real estate investors in a strict no sales pitch environment. FIBI is now the largest group of public real estate investor meetings in California with over 30,000 members. Jeremy has an MBA from the Wharton School, is a licensed California real estate broker for investing purposes only, and is an advisor for Realty Mogul, the largest real estate crowdfunding website in the US. Jeremy welcomes emails. He prefers emails, I can tell you that much, whereas don't email me, do email Jeremy at jroll, that's R-O-L-L, jroll at rollinvestments.com. He loves to network with others. He loves to help others and to discuss real estate and business opportunities. Jeremy, it is so good to have you here. Thank you for taking the time.
Thank you. Sorry, that was a little bit of a handful, that bio, but thank you for having me. I certainly hope the episode is helpful for your listeners.
I hope so too. I mean, I, as you know, my focus is very specific. I want to give a sense of the background and the expertise, maybe some information and knowledge on how you manage being a full-time passive investor, that is truly your career now, is to be a full-time real estate investor, which people want to do and want to be. And then also some sense of, well, what does it really mean, or what does it really take to be a successful investor? Because it's not all stars all the time. It's not all, not all glory and ice cream, and cherry on tops. It is sometimes just a pain in the patootie. So I like to, I like to try to get real. I know people tease me all the time. I've been spending too much time with my daughter, they say. But the truth is I've always spoken that way because I can't say a pain in the patata without it being blinked out. So there you go.
Oh, there you go.
So there you go. So Jeremy, it's really good. Tell us a little bit about your background before real estate. I think that's important in your particular story because it sets up why being a full-time passive investor is for me, when I observe you, it's not just I'm a full-time passive investor, it's practically a passion, right? There is a lot of focus that you give to that specific platform in your specific way. So tell us your background and then move forward.
Yes. So thanks again for having me on. So I am originally from Montreal, Canada, and I have 10 years of corporate experience, or more than 10 years of corporate experience before I left the corporate world in 2007 to become a full-time passive cash flow investor. And so the journey for me was I was working actually at Disney headquarters in Los Angeles here in Burbank in 2002, and the dot-com crash had just happened. And I was just sick and tired of the stock market for my own investment purposes for my long-term retirement for two reasons. One was really the lack of predictability in terms of I don't know where my retirement account was going to be in like 10, 20, 30 years because the stock market, we don't know where it's going to be next year. It could be down, up. And at that time, the volatility made it even worse because it's just not my personality to watch the stock market go up and down 30% in a year after the dot-com crash. So I started to look at different ways to invest for more predictability, really is what it came down to for me. And that's how I landed on focusing on real estate. But I focus on more, more lower risk, highly occupied, stabilized type of properties for more predictable cash flow. And that's what I started to focus on because it was the right fit for me back in 2002. And I still focus on that today. We're recording this right towards the end of 2020, so it's almost 19 years later. So that's my main focus. And that's how I got into the cash flow side of things. But I was, climbing up the corporate ladder. I have a Wharton MBA. I worked at Disney. My last two jobs were at Toyota headquarters and Disney headquarters in LA. I worked at GM headquarters. I worked at a couple of startups. I was just doing climbing up the corporate ladder, right? Mm-hmm. And but the cash flow has completely changed my life. I take it for granted, to be totally honest, which is not great. But I mean, it's been so long now that I think I now have been investing longer than I had corporate experience, like full time. So there you go. So it's hard to not take for granted at this point. But the cash flow completely changed my life, and it's been a pretty incredible journey for sure.
When it was very conscious on your part. I mean, there are some people I talk to them and their story is, like my story. I happened to be investing in real estate and I had a job at the same time. And then eventually real estate grew to the point where I went, hey, I should take this seriously. But I got the sense that you've actually always been trying to develop this sort of parallel path, whether it was in stocks or whether it was in real estate, to your job. And it was conscious and thoughtful.
It was yes and no. So what happened is that in 2002, I didn't say to myself, okay, I'm going to have a 5-year plan. I'm going to invest X amount per month or per year. And then I'm going to have Y amount of cash flow from that. I'm going to get out of the corporate world. That actually is not the plan that I had, which a lot of people do have. And I love seeing people execute on that plan and get out because it's great to watch. For me, it was more that I actually wanted to have the paycheck and the cash flow. The cash flow focus to me was very purposeful. It was for that predictability. So I'll take credit for that. But what I won't take credit for is I didn't say, okay, I'm going to get out of the corporate world one day from this. I was always in the corporate world thinking that I wasn't maximizing my potential. And it was killing me because I'm sitting behind a desk at a middle-level management job, supervising multiple people, Toyota headquarters, Disney headquarters, and it's a great job, and no one should complain. But I knew in my heart that I was not maximizing my potential. And to Christina's point before, my passion was always investing. I was always doing a lot of it on the side. I was always watching CNBC every day at work. And I just didn't realize that could be my full-time thing. And what happened for me is that once I rotated my money from stocks and bonds into cash flow, I was going to just have the paycheck and the cash flow and just keep going that route. But I had a last straw moment in the corporate world in 2007 with a new manager when I changed divisions within Toyota. And that was the worst thing that happened to me at the time, but the best thing that happened to me in retrospect, right? And that's actually what gave me the courage to actually say, I've got the cash flow I can live off of if I want to. Let me give this a try for a year or two. So, I'm a very low risk guy. So I had the cash flow coverage. I said, let me try it for a year or two, see what happens. And that's kind of been able to just continue on. And, my main objective is to just continue to grow my cash flow snowball so I never have to go back to the corporate world. That's been from the start since I left, from the day that I left the corporate world. And it continues today.
And that's part of your low risk. I mean, I think I've always felt that when you say, I don't want to risk any principal, that it's part of it is because it's earned. It's principle you had to work for.
Yes.
Right. So it's not like it's going to come another way.
Right. Yes. And it's also a really good personality fit for me. I've always been a low risk guy. And I think that's really important because there's 1,000 ways to invest. And if you're listening to this and you just happen to be more of a risk taker, or you're younger, you want to take more risk and you're into developments, for example, I've never invested in a development deal in 19 years, but you can make an argument that had I started down that path, I may have actually made even more money by it now, right? Because it's higher risk, higher return, but it's not the right fit for me. So I think the personality fit, there's 1,000 ways to invest, none of them are wrong. And I think the personality fit is really key.
Yeah. And I have to echo that same sentiment. Like it's, I've done active, I've done passive, and they both can be successful and they both can be unsuccessful. And then what is it that allows me to sleep the best at night? And what is it that brings me the most joy during my day is kind of where I've landed as the most valuable investments to me, because you can make money and you can lose money both directions.
Yes. And once you're in enough opportunities over time, you're inevitably never going to bat 1,000. Now that has different definitions, right? one person's definition of finding 1,000 is that they were below projections by 30% in a deal. Another definition is that they lost all their money in a deal, right? And there's everything in between. But the point is, once you're in enough deals, like I've been in over, I don't know how many deals I've been in, but I've easily been over 100, probably over 150. And things are going to happen. Like you can't bet 1,000. So to Christina's point, I try to bet as close as possible to 1,000, specifically because I go into low risk stuff where I feel like I have a bit of an advantage going in, because like 6 bad dominoes have to fall in the deal that I'm in for it to go really bad. Whereas a development, only 1 bad domino can fall potentially, and then it could go bad, right? So I should be doing better because I set myself up for higher predictability but lower return as a profile. But stuff's still going to happen for sure.
So let's stay with that for a minute, because you have become, I think, at least in my perception, you've become a bit of a mentor. Right? People look to you. We invite you to come speak at clubs, my club and other clubs. You've been on over 100 podcasts. You talked about just before we even turned on the recorder, right? So people look to you a bit as a mentor. What is it that you feel like people should understand if they're like you, and that they're really looking for high diversification and low risk in order to stay inside of what I call a particular box? I call it the risk time matrix, right? So I call you high time, low risk. And you sort of developed a skill set about how to do high time, low risk. And what's the skill set that you need in there to ensure that low risk? And why is it high time?
So great questions, really good points, actually. So first thing I'll say is that if you're listening to this and you're just starting out, right, the only difference between me and you is 19 years, right? So it's just time. That's the only advantage I have over somebody, is time, because time allows for learning, and it allows for networking, it allows for exposure to a lot of opportunities, a lot of learning, right? So first thing is that you got to start slow, probably focus on one asset class that you understand best to start. A lot of people, that's multifamily, because they maybe lived in a multifamily building. They can relate to the business model. It's somewhat straightforward compared to some others, right? But definitely take enough time to learn enough so that you understand what you're investing in to start. That's number one. Number two is, in my opinion, who you're making a bet on when you're passive. Because I tell people, as a passive investor, I give up control in exchange for diversification. That's kind of the way that I see it. So if I'm going to give control to somebody, it better be the right person, right? So I think that who I'm giving control to is even more important than the property I'm investing in itself, with the property being a really close second. So pay as much attention as possible as to who you're making a bet on, and do your best to weed that person out and get to a really good gut feel that it's the right person to make a bet on. That's number two. Obviously, focus on the property as well, and as much detail about the property as you can. Don't just go into investment blindly because your friend went into an investment. It may not be the right fit for you. Like we just talked about before, there's 1,000 ways to invest. Your friend may want to invest one way, you may want to invest another. You may get a different gut feel from a person that's different than your friend, and one of you may be right or wrong. You don't know, right? So you owe it to yourself to do all the due diligence up front. As a passive investor, you do all the work up front, and then you monitor how things are going after. So you've got to do the work up front just to maximize your potential, but also to maximize your probability of success, basically. Another thing I would say that I think a lot of passive investors, unfortunately, in my opinion, don't pay as much attention to is try to get the best understanding of how real estate cycles work and invest with the cycle. And Christina, I know you know that really well. And it's really
the school of real estate teaches you well.
Christina's been investing for decades, much longer than me even. And like you learn that over the cycles. So really easy examples. If I came to you in 2007 and said, I got a great deal, let's go buy it. In retrospect, you'd say, no, it's 2007. That's ridiculous. It's a bad idea. Like, in retrospect, right?
In retrospect.
Yes.
Right.
But if I said to you, it's 2010, let's go into a deal, I'd say, yeah, let's do it. That's a great time. Same building, same person to bet on, different timing, right? Real estate is cyclical. And so it's the old story, like I can invest in the best building with the best operator in 2007. It could be foreclosed in 2010. I can invest in the worst building with the worst operator, and we could have made a boatload of money from 2010 to 2017, even if it wasn't managed well, potentially, because we're going with the tide, right? So the cycles are ultra important. And I tend to be very careful with the cycles and particularly conservative. So I've been on the sidelines for several years now, just as from a mental perspective, kind of a general mindset, waiting for the cycle to turn again. And I did the same thing between 2005 and 2008. It's an agonizing, very long wait, but you've got to invest. It's really agonizing, but you've got to invest with the cycles. Yeah, it really is. Yeah. But you got to invest with the cycles because that's how you're going to maximize your probability of avoiding the challenges, right? And you can maximize your profits but I think a lot of people don't learn the real estate cycles necessarily. Don't learn like what to look for, and then just look at a building because they're getting into in 2018 or 19, and they just say, this looks like an interesting deal. My friend send it to me. I'll just go for it. But they're not taking the full cycle into account, right? And it's not their fault. It just even understand that there is a cycle and know that there's a cycle, but then learn how it works and where we are and formulate your opinion about where we are so that you can actually design your strategies around it, right? I think that's really critical. I think, unfortunately, a lot of passive investors don't do. Another thing I'll say as well, and I'll stop eventually, is that a lot of passive investors do not do background checks. And that's something that is an absolute mandatory thing for me. I do every time I invest with someone, again, because people can change over time or things can happen, but they've saved me multiple times. And I don't know how many people out of 10 do background checks, but my sense is that it's not, it's not 5 out of 10, and it may not even be 3 out of 10, unfortunately. I don't know, but I don't hear about that often. And I think it's a critical step as well. So those are just some things coming to mind.
I think that I'm going to echo you on the background check because you're the one who actually taught me about the background check, right? It's from going to your meetings when you had meetings, which was a while ago in the 2011, 12 time period. I think maybe I started going in 2008 or 9 because that's when I started my meeting, I think 2011. So I started going to your meeting first. And of course, your meeting was focused on passive investments and the economy cycles. And that was a big conversation at the time, was the cycle we were in. And that was hugely important. And so you're the one who's like background checks. You told me I use TLO, which is what you suggested to me. I don't know if you still use them, but I use TLO.
I do. Yeah.
Yep. And I do. And I use it for all of my investments, all the people I invest with. And I use it for all my clients, and being able to I can't, there's limitations around what I can share with my clients, but I can say if I feel like there are red flags or not. I'm capable of offering some sense of clarity on whether I would support that person as an investor, right, or not.
Have you actually, has that saved you multiple times already?
What's funny is that I have both stories. I have one story where there was an opportunity that was offering a 20% return. I did a background check. One of the members, there was 2 or 3 managing members, I don't remember, but I remember I did a background check on all the managing members, more than just one, more than just the primary managing, the name that was in front. And I was super glad I did, because the other person had 5 years of history. That was it. No previous real estate purchases, no previous car record, no previous homes, no previous entities to 5 years. And I went, that's a problem. If you don't show up at 40 something and have 5 years worth of history.
I don't think I've ever seen that before, honestly.
Well, that's an obvious one. That's why it's my favorite story, is because it's so incredibly obvious, right?
Yeah.
Versus, and I went, no, that's not going to work. And it was suspicious, 20% returns, promised annualized 20% returns. And I kind of went, it also, as an asset, concerns me the way they intend to run the project. If they're promising me 20% returns, that's concerning to me. So I said, no, this doesn't feel good. And sure enough, I believe, and I can't tell you what paper I saw it in, but I do know I had seen it in a paper, and somebody mentioned to me, have you heard of blank company? And I went, yeah, actually I have heard of them. And they were under investigation.
Oh yeah.
Right.
Yeah.
So like, that's the obvious story of why is a background check so important versus somebody has a couple speeding tickets and I'm like, well, just don't lend this guy your car, and don't lend him your car, and don't make the car be the primary asset that we're talking about, because clearly the guy just drives too fast.
Nice.
Right?
Well, let me just share a quick story that I had once, because it's the most obvious one I've ever had. I've had many, but the most obvious one I ever had was, there was a guy who I did a background check. He was moving from state to state every few years, but what would happen is that in the first state he had like 15 people suing him. In the second state, he had like 15 people suing him, right? And now he's on to his third state. And you're like, well, even if those lawsuits, none of them were justified, which is very hard to believe with that many individuals suing somebody like randomly, right? Even if that's the case, something's still not worth taking a risk on, even if none of that was legitimate, right? But the point is, it seemed like he was doing a fraud or doing whatever he was doing and then just leaving town, right?
Right, and then leaving town.
Right, and so, you would never know that, right? If you don't run that background check, you're going to be that person's victim. It's really that simple.
Yeah, I mean, I've got a client I'm working with right now where, they invested in 2016, I think, And then in 2017, all the papers blow up with this like, gee, they're selling condos and all the condos are above market price and they have management company. It was turnkeys and da da da. And it ends up being that they're, effectively selling condos that are 30,000 to 40,000 above market. And now everybody's mad at them because there really isn't value. And they're not cash flowing the way they said they would cash flow on their prospectus. And then enough investors start going, oh, you know what? Maybe I should have done my due diligence on the value of the property, market value of the property, and the operator to understand there really were already bad reviews out there about this person's previous behavior of having done this before, right? And that's the kind of thing you run into if you just do a TLO background check and I do a Google search, which I suspect you do as well.
Yeah.
Right. And I look at their entities and I look at the entities they've had before that you can find on the background check, right? Their current entities and their previous entities.
Yeah. I had a similar story where I was actually making a business investment in someone. I've been investing in ATMs since 2008 with a couple different operators. And this was an ancillary investment, not in ATMs, but in these terminal, I don't know why, but basically they're like debit card swipers, like, that type of thing. And and this person had multiple people basically pursuing them on the ATM side, and even got fined by the government and everything. But then they just pivoted and did a different line of business, right? That was tangential. And again, had you not done the background check and also the Google search, you'd see both sides, right? But you could have maybe missed it in one of them. Same story. So this stuff happens. You just have to catch it up front.
It does happen, and you do need to catch it. And that really is the importance of the due diligence and the depth of the due diligence before, especially if you're going to be a passive investor, because your biggest choice point is what you do up front. Once you're invested, there's not a lot of other choice points along the way. And I know you work at, not only do you do the background check and not only do you do the Google search and you confirm that the performance of the plan, right, is going to be something that's fiscally sound, right? The asset works and the trajectory works against the economy, right? That it's not, it's like if you're going to invest, if you got a downturning economy, then storage units is probably a better idea, right? But you also, I think you spend some time in trying to understand, and I think I just lost my point. The contract you're actually signing. What's the agreement they're actually putting forward?
Yes, that's hugely important, because the challenge with being a passive investor is that you're giving someone control.
Right.
But if you do not read the rules as to what you're signing up for, those are the legal rules that they have to follow. And I've seen some weird stuff. And if you don't read all I saw one deal where I was absolutely convinced that everybody who signed up for it didn't read the legal documents. Because if you had read the legal documents, you would never, ever invest in it. Right. It would have to do with a cash call and these crazy terms they put in that were just off the wall and very onerous against the investors. But the point is that you have to read the legal documents, because you're signing up for those rules. And once you sign, you can't turn to somebody in retrospect and say to an attorney or a judge, oh, I didn't know. No, you signed the documents, right? You just didn't read them, right?
You signed the documents.
And it was very clear, by the way, if you read them. So yeah, those legal documents are very important so you can understand the rules you're signing up for. The biggest challenge is that in this type of investing at the moment, you cannot press sell on your computer screen and get out of an opportunity in 2 or 3 days like a stock. In the future, that might become available down the line, but for now, that's just not an option. And so you're completely illiquid, very hard to sell out of your position. So you've got to do as much work as possible up front to be as comfortable as possible and as comprehensive as possible up front, because once your money's in someone else's hands, it's very hard to get back in this type of investing.
Right. And one of the things that I do is I look for the consistency between the marketing piece, the languaging they're telling me on my phone call, the PPM, and then what's in the LLC document. And if I find inconsistencies, because the LLC document is the ruling document, it's the one I sign, it's the one I'm gonna have to take to court. And if there's inconsistencies between the PPM and the ruling document, which is the LLC document, then it's like, no, that's not okay with me.
Yeah, and another thing you can find inconsistencies with is actually what the documents say the rules are, but what the operators say they do. I actually see this more often than you would think, where I would say, for a cash call, I didn't know you had to do this and this and this. And they say, no, that's not what I do. And they say, well, no, that's actually in your documents. And I think what that comes down to is actually not someone lying to you most of the time, as far as I can tell. It's actually someone who maybe didn't read the documents every word themselves, the operator who did not read the documents every word themselves from their attorneys, who maybe told their attorneys, I do X, Y, and Z, but it got lost in translation. They didn't review it. And now they're actually signing up for rules they didn't even realize, right? That's a whole different problem too. So it's really important to read those rules and understand what you're signing up for.
It is. I mean, that due diligence, the security that you get in that is probably the best. Having done proper due diligence gives you the best security and leverage in having a portfolio that's going to be low risk. There's diversification, which clearly you're into a high level of diversification.
Yeah, I am hyper diverse. I don't actually recommend what I do is because I'm in over 60 LLCs today, and I was in over 30 sales in the last 3 to 4 years. So that's like that's a lot, and I do it full time, and I like the concept of diversification. So what happens over time, you just naturally become more and more diversified of more and more things just because of time.
Yeah.
But I still don't, I'm not a financial advisor, investment advisor, but having the number of things I'm in is probably uncommon, and it's a lot of work, and that's why I say I don't recommend it. But at the same time, I absolutely think that being diversified across asset classes, geographies, and operators is key. And I think you want to avoid
notice listeners, he said all three.
Yes.
Asset classes, geography, and syndicators.
Yes, you do not want to have a Bernie Madoff effect happen to you, right? So you got to be diversified across that. You don't want to have your entire portfolio on the beach in Miami Beach and it gets wiped out by a hurricane.
Mm-hmm.
And you don't want to have all your portfolio in very large shopping malls 10 years ago and now you've got a big problem, right?
Hotels today.
Or hotels today with the pandemic. So you want to be as diversified as you can be, which is, I think, even more important, both because you're giving control to somebody else and because these are illiquid assets. So you can't just go and sell them quickly to get out of them once you made that decision. So that diversification is absolutely key. And honestly, if I don't trade control for diversification, what am I trading control for? Right? I mean, I get to leverage someone else's time, credit, money, expertise, and everything else, granted. But if I'm not going to then make sure that I actually get the proper diversification, I'm going to have an increased risk because if you can never get rid of the Ponzi scheme, mismanagement, fraud risks. You can't get rid of them. You could do your best to minimize them. You could do background checks and everything we talked about, but they cannot go to zero. It's impossible. I'm actually in a deal right now where I've invested with somebody 20 times over the course of 19 years. And one of the 3 managing members finally last year actually took a little bit of money from the reserves across some of the properties and just got caught. Okay. Wow. 19 years later. And by the way, 19 years later, and it's not even causing a major problem, thank God, but we're getting rid of him. It's, we're having a transition from them and everything. But the point is these things can happen even years and decades later, right? So you still have to be diversified across people as much as possible and try to minimize that risk because you can never take it to zero.
So let me go to my next question because you just laid the groundwork for it. So I'm a great believer that real estate is, there is a school of real estate and it's going to reward you in many ways and it's going to hand you lessons. So why don't you tell me what is the worst investment or the worst thing you've had happen to you in real estate and what did you learn from it?
Good question. So I had, I have many, a number of stories I could pull from, but I think
pick one. Go ahead.
I'll tell you my favorite story because it's the only foreclosure I've ever been in. Okay, thankfully, but it's also one of the best, probably the best outcome you can have from a foreclosure period. And it's just fascinating because it all came to I made a bet on. Okay, so it's a great story. So I invested in a student housing apartment building over 300 units in Michigan in 2008 in January. And honestly, my thesis at the time is there was going to be a downturn at some point. Students go back to school during downturns. This building is going to get through. It's 100% occupied. It's the first property across from a state university campus, a large campus. There's going to be continued demand at that school. Great thesis. Thesis holds through the recession, no problem. By the way, these guys own 17 other different student housing properties, ton of experience. Okay. Most of the buildings they actually own directly themselves and didn't even syndicate out. So they're very high net worth. Okay. So we go through the first 3 years. Everything's perfect. We're getting all the cash flow. Everything's fine. So spring comes around in 2012, and we get a notice from the city that the bridge to campus has to be closed during the summer for repairs because they have to repair it during summer months because it's a cold climate, right? It's in Michigan. But don't worry, it's going to be open for this fall school season, right?
Right.
And
don't worry.
All the residents in the area get a building from the city that there's repairs coming up. So, of course, our occupancy, people get scared that the bridge isn't going to be open in time for school. And our occupancy drops from 100% to effectively 65%. So
65%. That's quite a drop. But I mean, I guess it's student housing, so the rotation's quicker.
Well, yeah, and that's right. So it's annual, and they could just choose to live somewhere else. That's not going to cause this problem for the school year, right?
Yeah.
So we're at 65% occupancy in the fall. That was domino number one, right? Domino number two is that we had assumed a loan as part of this deal that was actually due in the fall of 2012. Okay, bad coincidence. Very bad.
Bad. Yes.
What I call a 1% risk, right? But that's
Right.
going to happen. It cannot be predicted, right? Domino number three, the bank would not extend the loan for a year because it's fairly obvious that if we extend the loan for a year, the bridge had actually reopened as scheduled, but we didn't have a very high occupancy. But the way the student housing works is there's a rental season, and once everybody's in their buildings in September, no one's coming into your building in November, right? It's already done. Everyone lives where they need to live for the year. So that's domino number three. The bank probably wanted the property back because I can't think of another reason why they wouldn't have extended the loan even for like a point or whatever for the year, right? So we're in an impossible situation, and we cannot get refinanced at 65% occupancy with the debt coverage ratio and everything. So we get foreclosed. Okay. So not the operator's fault, managing the building really well. Very hard to predict this stuff. Like just there's I can give you 21% risks a way a deal can go bad. This is a great example, right? That's why you have to be diversified, by the way, right? That's another great reason to be diversified. So here's what happened though in this story. Operator turns to the investor, says, and by the way, there was a partial recourse loan that they had to come out of pocket with. They were the majority investor in the deal. They lost all that money themselves. They turn to the investors and say, we feel really bad. It never happened to us before. We're going to actually transfer all of your equity from this property into another property we own across the first property from another state university campus in Texas. So no legal obligation whatsoever. They just felt bad, right? They could have walked away, said, sorry, like this is the 1% risk of investing. We did everything we could. We couldn't make it work. We've lost a ton of money and I'm sorry, right? You made some cash flow for a few years. You lost your principal. That actually would have been, as an investor, completely acceptable to me, right? That's a risk. They transfer everyone's equity into another property. I'm still in that property today, earning cash flow. Took a year to figure out the tax implications, the accounting and everything else. I had no cash flow for a year, but literally the only foreclosure I've ever been in resulted in a 1-year lag of cash flow, and then it just continued on. Now, this entire story, the lesson is things actually that came from it. The first, well, there's multiple lessons actually. The first is the only reason why I'm still in a property today getting cash flow is because of who I made a bet on, not because of the property, right? Number two is, in addition to that, it wasn't that the person actually wanted to help. It's that they actually were the kind of person that wanted to help and was capable of helping. So higher net worth operator can be more helpful at times to either provide a bridge loan to a property if they need it instead of a cash call, and do all kinds of things that another person may not have the option to do. But you still have to choose that option if you have the capital. So the highest net worth person in the world could have said, this is just an investor problem, right? Or just fair, that's life.
Right.
And
I have the legal right to walk away, I'm going to.
Exactly.
Right.
So, and actually that would actually make sense in it because they can afford to defend themselves. They have the money, right? So, but no, this person chose to make everybody whole and bring them into another deal. So you have to have the mindset in combination with the net worth. But all things being equal, I now tell people if you can invest with the higher net worth operator who has the mindset of helping when something goes bad, that reduces your risk, right? That's another lesson.
Yeah.
Another lesson for me, which was great, is that we got a really good deal on the building at the time, but being a low risk guy, was it worth the trade-off of having a loan due in 4 years instead of 10 years? Because if this would have happened when the loan was due in 10 years, I would have at least had 10 years of cash flow from it before this happened, right? So I've always focused on longer term, like fixed rate loans for more predictability for myself. And this was, of course, was one of the few instances that I went against that. And then it eventually bit me in the, what did you call it before?
Patootie.
Patootie, there you go.
Patootie, yes.
So really, this is multiple lessons, great example of 1% risk you can't predict. I could tell you about fires, insurance not paying. I'm just saying like all these other 1% risks that can happen that just requires diversification. It's absolutely key.
Okay. So you have very carefully, I'm going to change topics altogether, right? Because you have very carefully, like I said, walked out of your job, created this parallel, what originally was supposed to be a parallel cash flow, left your job through, reasons of the moment in the job, and went, hey, I'm here, right? But you seem to have cultivated a sense of financial stability and freedom for a very long time.
Yeah.
And so, I suspect by now, just because you have been at this for, like you said, just almost 19 years, that there's a financial freedom that you have in your world. That if you wanted to stop actively cultivating 60 different investments and you wanted to pare back and say, hey, I just want to do 20 or 40 and I don't have to do as much reviews and I don't have to consult with Ability Mogul and I don't need to do the Jeremy Wohl Investment Group, blah, 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 that you could back up even further and truly be a part-time investor and still have your cash flow. Like, what does financial freedom mean to you? Is it really having that time or is it really something else? Like, why make that such a high priority?
Yeah, that's a good question. Definitely a long conversation, I suppose we can have with, maybe bring a psychologist in too. But I will say this.
It's okay. It's all right. I won't ask you to lay down on the sofa and I won't pull out my notepad or anything. It's, I ask the same question of everybody I interview.
Yeah, it's a really good question. For me, I think you hit the nail on the head early on in this interview, which was the investing has always been a passion for me. And if you said to me, okay, Jeremy, stop working as much and just do 10 hours of maintenance a week on your portfolio and bring it down, pare it down to 20 or 10 deals and make your life much easier, I technically could. Now the thing is, it would take some time because I'm in stuff that's only going to exit in 10 years from now or 5 years from now. So to be able to dwindle it down will take me actually a number of years to get to that point, right? Because I'm not like I'm in 60 things right now. I'm not going to be in 10 things tomorrow. It doesn't work like that. But I will eventually head in that direction at some point. That being said, what am I going to do with the other 30 hours? Or, I work more than 40 hours a week right now, but what am I going to do with the other 30 hours, right? I really enjoy this. I love networking. I love talking to other people. It's an essential thing to do to be able to maintain and grow this. Networking is the number one focus of my day. The hardest part of my day is finding opportunities. The solution has been and will continue to be networking. So thankfully, I love networking. And so one thing I've done, over the course of the past few years, as things have slowed down in the cycle, is I've taken more and more calls where I just do free. I don't consult, whatever, just free calls, helping people, et cetera, because I had the time. That's going to shift now because I'm going to go back into some more investing with the cycle, so to speak. But I still kept myself really busy, just even from that perspective, but still within the investor mindset and how I can help and that type of thing. So it's slowing down to me isn't an option, but there's another reason why it's not an option, because I'm the kind of person that is more A-type, that if I slow down, it's really going to bother me because I'm going to go back to I'm not maximizing my potential. If something gets screwed up, it's going to be my fault, right? If I end up in 10 things and 5 of them go bad, that's my fault because I wasn't diversified enough, and it's always going to be on me. So there's an underlying anxiety that makes me try to maximize things all the time. Just honest answer,
I know, I love the honesty of the answer because it has both the joy and the concern all wrapped up into it.
Yeah. So that's the honest answer. What I think I'm probably going to do eventually is transition a little bit out of this, maybe in 10 or 20 years, because of liquidity when I get older, not because I don't want to keep doing it. And I don't want to necessarily have to hand it off to my next of kin or whatever it is, where they don't either want this, understand it, or don't like the lack of liquidity, et cetera. So that's kind of what my preliminary plan at the moment. So this is going to keep going for a long time, I hope. And even when it doesn't continue going in the end, it won't really be about choice. It'll be more about planning, Right.
And, I have this joke about, when am I going to stop investing? I was even having the conversation with my sister the other day. I said, hey, I've hit 52 years old. I figure I have another good 35 to 40 years of investing. And she's like, how old are you going to live? And I'm like, you don't understand. I can work at investing all the way until they take the pen out of my hand.
Yes.
Right? Like you can keep working at managing your portfolio at 60 investments or 40 investments, or, okay, let's say you simplify to 35 investments because now you're semi-retired, but you can keep doing this as long as you've got a pen in your hand and the deals make sense to your brain.
Yes. And I think that if you think about technology, right? So we're recording this right now remotely. That probably wasn't possible maybe 10 years ago with both the speed of processors, internet, et cetera. So you can only think that it's going to be easier and easier to do that over time, to manage things remotely and to just continue along this path as an investor. So, and I think there'll be more options. I personally think eventually real estate, I think it's going to start next year, is going to be tradable on stock exchanges. I think that I'm going to be able to sell fractions of my interest in some of these things eventually. They'll be much more liquid. So maybe I'll be able to keep on real estate the entire time if I want to, right?
Wow. Right.
Yeah, I think there'll be a lot of changes eventually, just making it easier and easier to be able to maintain this for sure.
All right. Now I've completely avoided this question, but I'm going to roll it out anyways. Can I have you for another 5 minutes?
Yeah, sure.
Okay. Because you're the type of person who would answer this. And it might take you longer than 5 minutes, What do you think is going to be the financial unraveling of COVID? We're in December of 2020,
Okay.
right? We've just elected in, or believe we may have elected in, a new president, which will be hopefully confirmed by January 20th, right? 2021. But what do you think is going to be the financial unrolling of this? I'm just going to leave it at that. I could lay out a lot of economic details, but I'm going to let you just take it from there.
Yeah, so I've been waiting to see what's going to happen because I'm really low risk. So for right now, when we're recording this, there hasn't been a second stimulus package that has been even really floated realistically yet, or almost agreed upon, or that type of thing. So we're waiting for that. To me, the unraveling there's a lot of different scenarios. And the only way we're going to know what it's going to look like is when we figure out what type of government support is going to be available. Mm-hmm. Because if you took away all the government support, we can have a pretty good conversation about what would happen, because that would be another recession.
Right. It would be much more predictable. Right. We know certain economic factors, certain unemployment would affect, rents in certain ways, and blah, blah, blah. Mm-hmm.
It would be what I call the recessionary dominoes, and we kind of know how that goes to an extent, right? So, right. But we don't know how that goes because the government has actually stopped the dominoes from falling for the most part so far. The question is, are they going to keep stopping the dominoes from falling? And even if they do, does that mean that all the dominoes are going to fall after, only 2 or 4 or 6? So that's what we're waiting to find out, right? Mm-hmm. So I can't predict what's going to happen because it's all artificial, and that is all completely affected by the government, and it's completely up to the government to make that decision. And I actually, as an investor, would prefer that wasn't the case. I don't mean like the government shouldn't help people whatsoever. It's not all what I'm saying. I'm just saying if the government wasn't a factor, I'd be able to actually have a much easier time predicting and have a much easier time investing for myself right now. So what I've chosen to do instead is just wait for the government to tell us what it's going to do and not take any risks in the meantime, just because I'm really low risk. So I've been sitting on the sidelines throughout COVID for the most part, continue to do so, and just waiting to see how the government's going to play this, and therefore which dominoes are going to fall. That's my much less than 5-minute answer for you.
Congratulations, because there's a lot of things to talk to in there. But I don't disagree with you. It ends up being, yes.
Yeah, so I know you appreciate economics. So let me float something else out to you that I think is even more interesting to consider down the road, further out, which is, and I really we don't want to get into this for too long on this podcast, but my concern is actually all the money printing. And what I mean by that is, if you look at in the 2000 decade in the US, we had a long run GDP potential every year, probably like 4%. Your economy could do 4%, and that was reasonable. And you can get there if the government provided the right programs and the economy was at a certain place, et cetera. And we did hit that at those times. In 2009, we had a lot of money printing. It was less than we have now, but we still had a lot compared to historical. And what it did is start to create more of a drag, because we are already at a pretty high level on the economy and on payments and what the government can afford to do.
Right. Debt to GDP.
Right. So that created a scenario when now we're at 3% for the 2010 decade, meaning that no matter what Trump was saying we're trying to do here, it wasn't realistic for him to get over 3% because there were too many other issues at play, too much debt, et cetera. It just wasn't the way, it's math, and it's just not the way what math works. Okay. So we couldn't get over 3%. And that's why this recovery was a very weak recovery on average per year, and from a GDP growth perspective. That's one of the reasons. So now you have all this money printing, right? Much more than before, and continuing on. So now what's going to happen is that in the next cycle that we're going to go into here soon, we're going to have, I'm guessing, somewhere between 0.5% and 2% long run potential GDP growth for the 2020 decade. Okay. Now I don't know what it's going to be. I don't know if it's going to be 1%, 2%. I'm hoping it's 2%. Okay, but call it 1% to 2%. Might be lower, might be higher. Call it 2% for argument's sake. So now we get through another cycle where, as investors, you and I know that our GDP potential is 2%. Probably we're going to be positive most or all years, and we're going to have what I call more predictable regular cycle, right? It won't be a very high growth. Okay.
Okay.
The question I have is what happens the next time after that? Because the next time after that, with more money printing and another downturn, which is the most likely or probable scenario that's going to occur, the government response, that's where you run into Japan. And that's scary to me. So my theory at the moment is that this is going to be possibly the last normal cycle we have as investors, to assume that assets will go up in value, that rents will go up in value, and that society will function as a regular cycle, both economically but also real estate.
Okay.
After the next cycle, meaning once we have not this downturn, but maybe another 10 years from now, that's where I start to say, well, what's happened in Japan with the amount of debt that they've had is that one quarter they have negative -1 GDP. The next quarter they're plus 0.5. The next quarter they're minus 0.5. There is no predictability. The predictability is gone. The government is in a constant state of crisis, trying to keep the economy afloat and print as much money as it can to keep it there. The government owns more than 40% of all outstanding public stock.
Mm.
That's how desperate they are.
Okay, to shore up their companies or corporations.
And essentially has done everything it can to keep interest rates, between 0 and 1% the entire time, because it can't manage things for its own debt if it gets too high, right? We're going to end up in that place at some point.
Okay.
And what happens is that without that predictability, do you want to be investing in an economy where it could be negative 0.5 GDP this quarter, +1 the next quarter, -1 the next quarter? We could have a recession 2 quarters down, and then in another year we have +1.5. It's completely unpredictable. We're teetering. You're basically teetering on the line the entire time, and it all comes down to how much is the government doing and how successful are they. And by the way, even with everything they can do, they still can't actually mitigate all the forces properly, right? So to me, I'm actually less worried about COVID, even though it's a short-term focus. I'm much more worried about the long-term, like I talked about before. And what I'm planning on is having one more regular cycle and evaluating whether I want to get into another cycle or not, or how I get into another cycle, and what does that mean? Does that mean that I look for much longer term plays for cash without worrying about the asset value? Do I not participate as much and roll into other things over that time, et cetera? So that I want to float that out to the listeners today, because I think no one's really thinking that far ahead at the moment.
Mm-hmm.
But I think it's very important to consider. And if you really want to learn more about this, I'd recommend looking at Japan and what they've gone through in the last 30 years, because I think that's it's not a perfect parallel. There's demographic differences, but the debt, the printing money, you'll see what happened in Japan. We will eventually we're on that path already. We've been on that path, but just far behind. It's almost like a train. It's ahead of you, but way ahead of you.
Exactly.
We're on a track, and it's the same track, and it's going to the same place in the end, right?
Right.
It's a question of how fast is your train going versus the next train ahead of you. So I definitely recommend people take a look at that and think about that for the longer term.
Okay. That's a lot. That's a lot. And I'm glad that you took the time to share it so that it's on my brain, because I haven't thought that far ahead on it. I admit.
Yeah, I had a lame COVID answer, so I figured I'll give you a better answer. So.
No, I thought the lame COVID answer was an honest and authentic answer, because I tried to call it early, saying, hey, and a lot of us did, right? Hey, what's going to be the natural result of COVID is going to be closures of businesses, losses in unemployment, right? Because that would be, and then we would lose, blah, blah, blah. And then, but then it's like, well, and so we would immediately see, downturn in rents, increases in vacancy, and what is it going to affect,
Yes.
right? And then we went, okay, well, it's going to be leisure, and who knew about elderly until it showed up, right? It's going to be leisure and it's going to be elderly. And then, so that's what we were predicting. And then real estate was going to crash, but real estate didn't crash because who knew about the moving bug, that people were so uncomfortable in their own homes, in their own skin, right? That everybody's kind of up and moving, and not a lot of assets are on the market in comparison to the demand of people wanting to move.
Right.
So now we have this forced false environment that is truly temporary, in that it is due to COVID, not what I saw coming. So,
but let's talk about the reverse of that, which is,
sure.
What about all the people who are living in big cities like LA, where I live, where the crime and other things have gotten worse, and these are just statistically,
They have. Suicide's gone up, divorces have gone up, crime has gone up, violence has gone up because of COVID.
But people are scared of moving at the moment. But what happens when they're not scared of moving? Does that mean there's going to be the opposite problem, where there's a lot more inventory once people feel comfortable moving, and they're actually going to go to where they want to be potentially, versus where they're stuck being right now? It's kind of interesting to consider. I have no way of predicting that, but it's interesting to think about.
Yeah, I don't have any way to predict it either, because it's a little like, I feel it's a little like the game of musical chairs. And once everybody's adjusted their chairs, what's the game? What music's going to be playing next? Yeah. Right? We've all sort of taken care of our pent up demand, because the demand was created by this force. And it's like, we've settled in. Are we going to have another wave of people going, hey, I was wrong. I actually don't want to own 10 acres. I actually want to be in LA.
Yeah.
Right. I don't know.
And you can tell, like, based on hearing me say this, like, I don't work well with the lack of predictability. I avoid that. Right? Yes. So I sit on the sidelines in these situations. So it's definitely very hard to predict right now.
Thank you, Jeremy, for your time. Thank you for your economic forecasts. Thank you for your stories. Thank you for your tips on being a passive investor, and what are the things that you look for and that you use as guiding poles and indicators in being willing to make a passive investment. I really appreciate it. How can people get a hold of you if they want to find out about you, interview you, bring you onto their podcast, invite you to their meetings, or just have a conversation with you about, the investments you're doing? How do they get a hold of you?
Yeah, sure. I'm happy to network with anybody. So feel free to reach out to me. The best way to reach me is definitely my email. So that's jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com.
All right. Thank you, Jeremy. Thank you so much.
No problem. Thanks for having me on. I just hope it was helpful for your listeners.
I hope so too. This is Christina Suter with Real Estate Breakthrough. Tune in next week for another show.